So good morning, good afternoon, rather, everybody. Hope you're all well. This is Zubair Patel. I am the head of tax at the KPMG Kuwait Tax Department. And again, pleased to have you here. I'm joined by my colleagues, Fahim Bashir, who's the partner here, along with Hanan and Naveen. And we'll be supported by Misbah, um, obviously on the managing the slides at the back, and from Jamila, who is in our marketing department. So again, uh, afternoon to you all. So again, I think as you've been seeing, this is our fourth webinar in the series of the tax technical webinars that we have been running very successfully, and we have seen quite a big number of people registering. And again, thank you all for taking interest and taking your precious time out for these sessions. I think the kind of feedback that we have got, particularly after the third one, was that I think the deep dive that we're doing uh, on these sort of sessions, uh, I guess every month we've done that is really appreciated by our clients. And I think the discussion, the questions that have come through have been, something that's also been thought provoking at our side as well. So again, thank you for all the interest. And just to again go through what we're going to do within this session as we'll continue the discussions on the adjustments under the executive rules issued by the Kuwait Tax Authority. So all my colleagues, Fahim, Hanan, and Naveen will go through specific executive rules and the practical and pragmatic applications of that uh, for yourselves and what we see in the market. And obviously what we'll do in this session, maybe Ms. on the next slide, just to set out how this will pan out. Just in similar to what we have done in the previous sessions, we'll try to speak for 45 to 50 minutes and keep the last 10 minutes for the Q&A. I think we are we just moderating the questions. We might even take some questions mid the discussions to make sure that we bring the practical flavor that is relevant to our clients to the discussions. But that's just a general sort of synopsis of how this sessions uh, would look like. And again, please use the chat function to ask any questions. Um, in case we run out of time, because I know everybody is busy, it's a midday session, then we'll reach out to you on your particular questions. The session is being recorded and obviously will be shared on our social media channels. We will send the link to participant following the session, so you can always go back and refer to the discussions. The training materials, obviously, I think we can provide you that, but obviously subject to KPMG's consent. So next slide, please, in the interest of time. Yeah, I already discussed, the speakers. So again, joined by Fahim, you probably know from the other webinars. He's got substantial experience in Kuwait, along with Hanan and Naveen. So both Hanan and Naveen are tax directors. So definitely, I think we'll be having the more constructive discussions as we go along. So with that, I'll just hand over to Fahim. I'll be there in the background. I think any questions that we get from the clients, I'll be moderating and bringing to our speakers. So thank you, and over to you, Fahim.
Hi, thanks, Zubair. Good afternoon, everybody. I hope everybody can hear me. It's great to have you here again as part of our series on Kuwait tax. As we've been doing at the start of our sessions, we give you again a bit of a background, a feel to the key points of Kuwait tax that then become relevant as the discussions go along. So we'll start with that slide and we'll set the scene a little bit, and then I'll hand over to Naveen, who will go into some of the detailed points on the executive rules. So just really quickly, high level summary of the key points of Kuwait tax. The domestic law does not provide for a definition of a PE or domicile or residency. The tax law talks about contracts performed wholly or partially in Kuwait are subject to tax. And now that really is applied by the tax authority to mean that even a single day's presence in Kuwait establishes tax compliance obligations and a taxable presence. Uh, there are also other types of incomes that are taxable irrespective of physical presence. So, for example, license, royalties, interest earned by foreign banks. Um, and once a taxable presence is created, the foreign company that is filing and registering for tax purposes here has to incorporate all Kuwait-sourced income into a consolidated tax return, even if standalone elements may not be subject to tax in Kuwait. Of course, there are tax treaties that can potentially provide exemptions from Kuwait tax. We had covered tax treaties in a lot of detail in one of our earlier sessions, so please feel free to look at that in your own time. But there we talked about documentation requirement and the approach for the tax authority from a tax treaty exemption perspective. Uh, the other key element, of course, is the tax retentions regulations, whereby contract owners deduct 5% on payments to vendors, the service providers, subcontractors, until they are provided a tax clearance certificate and a no objection letter. So it is not a withholding tax because ultimately the amounts deducted are not remitted to the tax authority. So it's not a full-fledged withholding tax, and that's why we call it a retention. The amounts stay with the contract owner until that obligation and the no objection letter or tax clearance certificate is provided. And that applies across the board on vendors, on supply, on subcontractors, service providers, local companies, offshore companies. Uh, and obviously, there's big impact for taxpayers that are non-compliant because it impacts their tax filing, their ability to deduct for tax purposes those related costs on which compliance for retentions has not been applied. So that's a lot. That's an area where we see a lot of questions, and again, we have covered that in one of our previous sessions in a lot more detail. So please refer to that in your own time. So Misbah, if you can have the next slide, please. So really, when we look at today's session, we're going again into a deep dive of certain executive rules. There are many of them, so we can't obviously cover every one in this session. We covered some in the past session related to supply of material, offshore design, consultancy services, and really those imputation of profits on those key elements. Today, we're going into a bit more finer detail on specific cost items. And why we're doing that is that because the tax law requires taxpayers to file on an actual basis. So whilst there is a deemed profit basis accepted in practice at the moment by the tax authority, the base case should be that you're looking to file on an actual basis. And with that actual basis comes the annual tax inspection and assessment process. So every year, every taxpayer goes through a tax audit. It is not like other jurisdictions where it's a sample-based selection of taxpayers that are audited. Here it is every year for every taxpayer, even if it's the same contract, ongoing contracts, even if there's no material change in the nature of transactions or the activities of the company, there is still going to be a tax inspection. So obviously the compliance burden in Kuwait is significant and needs to be managed appropriately. During this process, tax authorities look to evidence robust documentations for revenue and costs, and they are verified to contract invoices, payment advices, etc. And then a part of that are the adjustments that the tax authority make in line with the executive rules. And these are the codified adjustments that we'll go through now, which are applied to the costs and are on an annual basis effectively. And because these are codified, uh, what clients and companies are doing is to reflect these in the tax returns themselves so that you have more alignment between what your tax return and what your final assessment will look like. So if you know that, for example, your agency commission is going to be restricted every year to 2%, and we'll go into that, then that adjustment is put into the tax return rather than waiting for the tax authority to make that adjustment in your assessment. Yeah. There are, of course, other arbitrary assessments that we see from the tax authority. I mean, those are on a case-by-case basis. They're not codified. It depends on the documentation. It depends on to a certain extent, the inspector looking at it. So those are arbitrary and really on a case-by-case basis. So today we'll go into six of the executive rules, six topics of executive rules, and I hand over to Naveen, who will talk about some of the regulations with respect to submission of tax returns to kick this off. Naveen, over to you.
Thank you, Fahim. Hi, good afternoon, everyone. We are covering few of the executive regulation, as Fahim mentioned. The first executive regulation we're covering is Executive Regulation number 9, which deals with submission of the tax return. As Fahim mentioned in starting of the presentation, that actual basis tax return, which normally law provides with. So there are two types of tax return. Normally the corporates are filing in Kuwait. One is actual basis, and the second is deemed profit basis. The law provides the documentations with regard to actual basis filing, while the deemed profit, which is being filed in practice and accepted by the tax department, which is not covered by the law, but recently the circular was issued later on, which covers that as well. So we'll cover that. So what companies who are subject to tax, they are first required to submit, they need to get registered and file the tax return. That's the prime thing. Second thing is the companies, even which feels they are exempt under the tax treaty, still they are required to file the tax return. That's the thing which one should keep in mind. The documentation required for the actual basis tax filing are as follows. The financial statement together with the tax return is required to be submitted. The tax return is required to be submitted in Arabic. Um, the financial statement should provide profit and loss account and balance sheet. In addition to that, a fixed asset register is also required to be attached if the company has got fixed assets in Kuwait. It should include the date of purchase, the type of assets, the class of assets it is, and what is the value of asset it should provide, and the rate of depreciation one is applying as per the tax law or as per their internal company policy. That should be included in the fixed asset register. The critical thing is the list of subcontractors that should also be part of the tax return as annexure. The list of subcontractor, as we already covered in earlier webinar, the subcontractors would include civil subcontractors, manpower hired subcontractors, equipment rental, etc. So the list of subcontractors by name and the value of the cost, what is already declared, should be given in detail as a part of annexure. Also, the last payment certificate, if it is issued by that subcontractor, should also be enclosed with the tax return. Also, the amounts retained on the subcontractors, as I mentioned in his initial slide, that 5% has to be retained. So whatever the cost is declared in that particular tax return, what is the amount retained on that particular subcontractor, that should also be part of the list. If the company is doing some EPC activity or trading activity, then the inventory list should also be there, which should include the category of the assets class, what is the inventory and what is the value it is being, and that these inventory should reconcile with your balance sheet, that what is the total amount of inventory, and that should reconcile with the balance sheet what inventory you are declaring. The revenue what you earn. So if it is the first year of filing, then the copies of revenue contracts are also required to be enclosed. And if there is amendment to the contract, then in the subsequent returns, those revenue contracts should also be forming part of the annexure to the tax return. In addition, the trial balance, and lastly, the final payment certificate. These are the things which are provided in the tax law, in which actual basis tax return should provide with. Now, the practical challenge is what we have seen, that as the tax return is required to be filed within 3.5 months from the year end of the relevant companies, the collation of all these data we have seen at times become challenging, because this is quite a lot of detail one need to collate in addition to finalization of the accounts within 3.5 months. So that is the one practical challenge we see. Um, as I mentioned, that in addition to actual basis, the deemed profit tax returns are also in practice accepted by the tax department. As per the circular and the practices with the tax declaration, the tax department is expecting the copies of invoices, proof of payment, and confirmation from your contract owner should also be provided with the tax return. Um, as you will appreciate that few of the sector of companies like where there is a lot of supply and multiple purchase orders, or you might have a part of retail sector there the copies of invoices and proof of payments are bulky, so these becomes practical challenge. So we have seen that the companies, rather than submitting all the copies of invoices, they give the revenue summary, and at the time of the tax audit, they may normally submit on a sample basis or as requested by the tax department. So these are the few challenges we have seen under while the companies are submitting the tax return. Can you please move on the next slide? Thank you. So moving on to the next Executive Regulation 24, which deals with pre-operating and maintenance cost. So what we have seen in Kuwait, normally the foreign companies are operating in Kuwait either as a quasi branch through a sponsorship arrangement, or they might have a WLL incorporated in Kuwait. So the companies, when they operate in Kuwait, they have a pre-operating cost. Now, the law provides that if the company is having any business in Kuwait and they sign a contract with any of the companies, so whatever cost is incurred before the signing of contract, as per the law, those costs are not allowed as a deductible cost. But any cost which is incurred after signing of the contract, but before the commencement of activity, that cost is allowed as deductible cost. It obviously has to be proved with the proper subsequent documentation, that what cost and how it is related to your business. So that cost can be claimed as deductible. Normally, as and when the operations are started, the company may claim that cost in that particular year against the revenue which is declared. And the cost which is so this is normally we have seen that companies which are operating as a branch, they would have these kind of things that they sign a contract. The second category of companies where we've seen is they operate through a limited liability company in Kuwait. So when the company is incorporated in Kuwait, they would incur some cost. So those kind of costs which is incurred prior to setting up of a company, those costs are normally not allowed by the tax department. But any cost which is incurred post incorporation and subsequent, they would have some administrative cost. So those costs we have seen that the tax department may challenge. So for example, if a foreign company set up a WLL, and after setting up of a company, they may not have a contract for a year or two, but they will incur some administrative cost in those years. Uh, when you file your tax return, you are expected to disclose those costs. But normally we have seen that those costs, if they are incurred before signing of the contract in year one or year two, one may attempt to claim those costs as deductible. But we have seen that, for example, if you have signed an incorporated company in year one and you incurred some cost, and the year two you sign an agreement, so normally the cost which is incurred after signing of agreement, that is allowed, but the cost which is incurred as an administrative cost after setting up a company, one may claim saying that this is to run the business or to before we get the contract. But we have seen that normally the tax department are challenging those costs as well and not allowing as a deductible cost. So these are for the pre-operating cost. Then moving on to the maintenance cost. Maintenance cost is when you have the contract is being over, but then the maintenance period is going on. While you may not have a revenue, but you may have a cost. So in those cases, if there is a provision being made, that may not be allowed. But the maintenance cost, if it is incurred, that will be deductible. And the period of maintenance will not be considered as a ceased activity. It will be considered as the activities which is going on. So the cost incurred during maintenance period normally is allowed on incurred basis, not on provision basis. The practical challenges, what we have
So,
seen in our experience.
hi, Naveen. Just a
Yeah.
question coming through that even if in the maintenance period, if supposing there is no revenue, the actual cost will still be allowed, right? Yes.
Yeah, so where that's a very valid question that we have seen that if there is no revenue, obviously the cost which you incur, it will have a loss. But if there is no revenue at all from any other projects, then we have seen that those losses may not be allowed to be carried forward, because while the law says that maintenance period as seen as not ceased activity, but if you don't have any operation during those year, and you don't have any revenue from any other activities, then unfortunately we have seen some practical cases that if the project is completed, those costs may not be allowed to be carried forward as a loss to the next year. So that's the practical challenges we have seen. But if you have other ongoing projects, then yes, you can offset those expenses with other profits or revenue you have got. Yeah.
Great.
So moving on to the practical challenges. So the practical challenges is that identifying the pre-operating cost. So how would you identify the pre-operating cost? That becomes a challenge, that the period after signing of the contract and before the operations are commenced. So that becomes critical. So you have to be very careful which cost you will claim as pre-operating, and which cost you will claim as uh, before post-operating of the project. So that becomes a little critical. Secondly, as I mentioned, that if you set up a company, that any cost which is incurred prior to setting up of a company, those costs are normally not allowed, even though it is ratified by the company after the company is set up, and the shareholders incurring those costs and they ratify in their AGM. But normally those costs may not be allowed. Cost will normally will be allowed is post setting up of a company, and once the project is awarded to you. One of the practical approach what we have seen is any cost which is incurred after signing of the contract, you may amortize over the period of the contract, or you may claim once the contract is commenced. So those costs you may claim in the year of first year of the operations once the contract is commenced, or you may take a view that you will apportion over the period of contract and claim throughout the period of the contract over the life of the contract. That's the one practical approach one would say take. That all depends on your planning, that how you expect the revenues to be flowed in, and how you expect the profits to be over the period of contract. And normally we have seen that if you capitalize and amortize over the year, over period of the contract, the tax department so far has, we have seen they are accepting it. Yeah. Move my next slide, please. Yeah. So moving on to the Executive Regulation 27, which deals with work in progress. Work in progress is one of the critical aspect, and which we have seen in our experience in specific with the construction companies and EPC companies, uh, where we see the challenges. So the work in progress is normally when the company has started the contract, and they are doing the activities. In those cases, we have seen that while the work is ongoing and the cost is being incurred, but there is no billing done by the company in that year. Excuse me, that is one case. Second is while there is an ongoing contract, but the revenue cannot be reliably measured against that cost. In these cases, we have seen that the company, as per the executive regulation, can take a position whether they will take a position to carry forward the cost to the next year rather than claiming the cost against the revenue for that particular year. So,
I think, Naveen, it's useful to highlight here that the regulations, whilst they state you file on actual basis, it doesn't state whether it's IFRS or other accounting principles. So the law is silent on that, and so therefore, what we see is clients filing on tax basis. So we follow the tax regulations, which then look at concepts like matching, right? So we match the ideal position is that you match your revenue in the period to the cost in the period. And where there's a mismatch, this topic of work in progress and what to carry forward arises. So I think it's really It stems from the fact that, percentage of completion is typically not accepted by tax authority. It's not IFRS based. It is very much tax basis, depending on the regulations and the activities of the company. Yeah.
Thanks, Fahim. Yeah, that's very valid point actually. That we have seen that a practical challenge that companies operating in Kuwait normally they are coming from the jurisdiction where they would be following IFRS basis accounting in their head offices, and even if they operate in Kuwait as a WLL, they would follow the IFRS. But the tax law doesn't allows in principle IFRS basis accounting, and that's where the challenge comes for the companies that whether they should follow the IFRS or they should follow the tax basis accounting. The Kuwait tax department normally accepts tax basis accounting where they don't follow the IFRS, so the percentage completion method unfortunately is not accepted by the tax department, and that's where this mismatch of revenue and cost comes into picture, and that's where the work in progress becomes very critical and relevant for the companies for their while filing the tax return. So looking at the first point, cost against which no corresponding revenue is attributable. So scenario one, where the company has started their operations and they have already only incurred cost, but there is no billing done that for that particular year, the company may take a position to carry forward the entire cost to the next year and report in the year where the revenue has been billed, and it could be reliably measured against the cost been incurred. That's one part. Second is where the operations has been started and cost has been incurred. The invoices has been done, but still the position is that either you have a position that you have a revenue and the cost, but there is a mismatch between revenue and cost. Either you have a case where there is a substantial loss, where the revenue is less and cost is much more. A scenario B, where you have a revenue which is much higher because you have billed a lot depending on the milestones or depending on the advance billing concept which you agreed, but you don't have a cost against that. For example, in case of supply, you can bill on a percentage basis that you will bill 50% of the value of the purchase order while the material is not imported to Kuwait. So you would have a mismatch in this case also, while in the engineering cases, you would bill on a particular activity basis. The activity is not complete, but the revenue is already billed. So you will see a mismatch of very high profit in the year one or two, and either you will have huge losses. So there you have to take a very a conscious approach that if you feel there is a mismatch in revenue and cost, and the revenue cannot be reliably measured against the cost incurred or the vice versa, you may take a position to carry forward to the next year. The practical challenges what we have seen is the tax department normally challenges is that where there is a mismatch of revenue and cost and one would like to carry forward. So now if you have a case where you have a substantial profit because of a mismatch of revenue and cost and you would like to carry forward to the next year, the tax department may challenge. But it's the other way around, that if you have got a loss situation where the revenues are not being reliably measured and the cost is higher and you tend to incur losses, in that case the tax department normally would challenge that, if you want, so if you have a loss they would accept, but if you have a profit they may challenge. So that's the, so to overcome this situation, you have to keep a very adequate document that why you are carry forwarding the revenue or the cost to the next year. So that one has to keep in mind that the documentations become very relevant. So you need to identify the cost which you want to carry forward to the next year. That's one. The second practical challenge what we have seen is the milestone versus progressive billing. So you would have seen the practical challenges that if you bill on a milestone basis, so your cost is being incurred on a particular uh, 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 incurring basis or on an accrual basis, but the milestones are agreed on a particular milestone which is agreed with your contract owner. So there could be a situation that your income would be much higher than the cost, or it could be other way around in a year one or year two, or as the year progress. So it's very difficult to identify how much is the cost to be carried forward against the milestone basis. While in a progressive basis, we have seen that the matching concept in general, depending on your contract, becomes easier. So you can, find out which is the cost. So that is the one of the challenge. Then cost which is still inspected in year and year incurred on. So normally the tax department would review, and even you will review that what is the cost you incurred, and you need to inspect by the tax department to prove that whether the carry forward of the cost was correct or not. And even you will see the adjustment which may impact on a subsequent period, because in year one you may carry forward to second year, but you may have a various huge losses in the next year also. So you need to look at the situation that whether carry forward of the cost to the next year will make sense, or you may report a minimal loss to the year. So the planning becomes very relevant. And then lastly, the accrued revenue approach versus loss. So basically, if you may take a position that whatever the revenue you have incurred, you have built during the year, would you like to take a position that you accrue some revenue based on the cost incurred and report to this year, or because of the huge losses you would like to carry forward to the next year?
Yeah.
So these are the
Yeah, thanks,
yeah.
Naveen. I think that's probably a good time to bring in Hanan. Maybe he can also touch upon some of these the work in progress aspects, because I know you've covered this a lot in your clients,
Yeah.
Hanan.
Thank,
And also then moving forward to the other topics. Yeah, just conscious of time. Yeah,
thank you.
go ahead, Hanan. Thanks, Naveen. Yeah.
Hi, good afternoon, everyone. Yeah, Fahim, I think this is where Naveen explained in detail, because work in progress is where we have, that where revenue and cost is not mismatched, and this is normally challenged by tax authority. So I think for the sake of time, we'll go to next slide. And if you have any questions on that, you can send us email and we can go in detail on that. Just before that, Misbah, can you go to previous slide, please? Yeah, we'll talk about payroll cost, which is one of the major expense of taxpayer. And this is very important that taxpayer should understand what are the requirements in the law for certain cost reported in the taxpayer to avoid any unnecessary disallowances. So when we're talking about payroll cost, we need to understand this can be a basic salary and allowances and bonuses paid to employees. Plus, it can be end of service benefits, leave salaries, which is given to the employees, can also be attributed as salaries in their annual cost. But it is important to note that as per the local labor law, this salary should be paid into the employer's bank account, and there are certain documentation required to claim such cost from tax perspective. So if you are paying salaries to your employees in their bank account, first of all, they need to be a resident of Kuwait. So tax authorities may ask for the bank advices of salaries transferred, either it is transferred directly by the company or through a sponsor arrangement. You need to provide bank advices for that. Then they may ask for your work permit of employees or civil ID copies to confirm that the employees are on the residency of the company. Tax authorities may ask for the passport copies as well. So those employees may be on sample basis to justify that such cost is related to the company. And in addition to that, sometimes tax authorities also ask for the employment contract to understand that such employees are eligible for allowances or bonuses paid on annual basis. So these are the things I think taxpayers they need to consider while preparing that salary documentation for their employees. In addition to that, end of service benefits and leave salaries should be calculated in line with local labor laws. That is really important, because if the calculations are not in line, uh, such costs will be disallowed by tax authorities. If you see the executive rule number 32 to 34, there is a calculation. Examples are given explained for the taxpayer to understand that how they need to calculate the salaries paid to employees, or end of service benefits paid as well. We'll talk in detail about the provisions part of end of service benefits, because end of service benefits provisions are not allowed in the law, which we'll be discussing in the next
One
slide.
question that is coming, and I think I know that's a practical challenge. People are
Sure,
saying,
please.
what percentage of payroll cost have we seen in practice being disallowed in an EPC scenario? Yeah.
Yeah, this is most of the time we are receiving this question. So, Zubair, as we mentioned, that we are talking about salary cost incurred in Kuwait. If you have all the documentation in place and salaries are paid in uh, bank accounts of employees, this cost should be fully allowed by tax authorities. But the challenge comes with the salaries paid outside Kuwait, where tax authorities normally challenge that, and they want supporting documentation to justify that such costs are in line with their project or contract in Kuwait. And we have seen, as this is on arbitrary basis and there's no fixed percentage defined in the law, this can be challenged. We have seen cases where tax authorities disallow a portion of the cost, and in some cases, tax authorities disallow fully some attributed or allocated salaries paid outside Kuwait. In addition to that, Zubair, there is one more thing. I think when we are calculating salaries, they need to understand that there is a general perception on bonuses as well, that when they are paying bonuses to their employees, this is allowable cost. But there is certain requirements in the law that bonuses only allowed to be paid to employees if a company is um, making profits. If a company is reporting losses on the project, then tax authorities don't allow any bonuses paid to employees. Or if the contract, as you mentioned in the start, that when the tax authorities is reviewing employment contract, an employment contract is not providing that such employees are eligible for certain allowances or bonuses, this cost also not be allowed. Another part is that this bonuses should be paid in Kuwait. Any bonus which is paid outside Kuwait will also not be allowed as a chargeable expense in Kuwait books. And if a company is making a profit on in Kuwait and they are eligible to claim bonuses, there is a limitation of up to 3 basic salaries to be paid as bonuses. If anything paid more than that by the management decision, this will be again disallowed by tax authorities. The practical challenges, I think Zubair has already highlighted that the major challenge is that the cost paid outside Kuwait, because if any cost paid to employees outside Kuwait, which can not be justified that this is related to Kuwait project, will be straight away disallowed by tax authorities. And we have also seen sometimes, the salaries are paid in Kuwait, but the documentation cannot justify that certain costs are related to your project, or uh, pay to employees who are on the sponsorship of your agent in Kuwait. This is also generally disallowed by tax authorities. And one
Yeah,
more,
and Hanan, I think we're
sorry.
seeing we are seeing, sorry, just to add, I think we are seeing more and more issues on payroll costs, because obviously it involves sharing of personal data. And obviously, when we're looking at personal data, it's so much regulation around this now coming throughout the world. Sharing data on payroll is not becoming the easiest thing. So, um, and because of that weakness in documentation that potentially is there because of data privacy and other regulations, the tax authority is then increasing the disallowances and or using that as the opportunity to disallow. But that's just, again, it's becoming a practical issue, just the way the world is with respect to personal data. So again, it's just in line with what you've said as well, but just something to add. Yeah.
Yeah, Fahim, you're absolutely right. And because of that, we can see that even the cost is paid in Kuwait. This is challenged by tax authorities, and companies are having disallowances. In addition to that, cash salaries as well. Cash salaries paid is not allowed in the law. And if a company is paying any salaries or side labor cost in cash, that is also challenged by tax authorities and subject to disallowance as well. Misbah, can you move to next slide, please? Yeah. Just one before. Yeah, thank you. So when we're talking about the end of service benefits, as I mentioned, that it should be in line with the labor law as per the calculations required in the law. But Normally, companies are putting a cost based on the provisions. But in the law, as the circular number 35 clearly provides that any provision uh, recorded as a cost is not allowed as chargeable expense, which includes end of service benefits, uh, bad debts, and on any slow moving stock provisions or any general provisions made, which can be in line with IFRS regulations, but still it is challenged by tax authorities that it should be claimed when the actual costs incurred. Like in end of service benefit case, as I mentioned in the last slide, if end of service benefits are paid to employees who are leaving the firm or terminated, this cost can be claimed as a chargeable cost in that financial year, but any cost which is uh, included as a provision will be disallowed by tax authorities. Same as bad debts as well. Normally, tax authorities challenge that. Even if the bad debts are actually incurred, tax authorities would require some legal documentation to prove that certain bad debts are actually incurred, and then will be allowed as a chargeable expense. But if you are making any provision on that based on the regulations, but tax authorities may disallow certain costs within the law. Then we have Executive Rule number 36, which talk about agency commission and limit the agency commission cap to 2% of the contract revenue, which excludes reimbursement revenue, and it should be excluding any offshore revenue allocated under the double taxation treaty. So 2% of the revenue which is incurred in Kuwait is allowed as agency commission. If you have arrangement with your agent which is more than 2%, it can be based on your based on the commercial reasons or based on your arrangement with sponsor. That additional cost reported in your tax return will be straight away disallowed by tax authorities. In addition to that, if your agent or sponsor is providing any services, like they are providing subcontractor or related services like manpower, equipment rental, or any other cost which is directly related to your major to the main contract, this cost or this amount paid to agent will be uh, excluded from the revenue before calculating 2% agency commission. So this is how tax authorities allow agency commission as a chargeable expense. In addition to that, if you are as a taxpayer, if taxpayer is participating in any Kuwaiti incorporated structure as a JV or unincorporated JV where Kuwaiti partner is participating, so in that case, no agency commission will be allowed as a chargeable expense to participating taxpayers in the venture, joint venture. The practical challenges, as I mentioned, that any accrual also you made in your financial statement or reported in your tax return, that can be only allowed if you justify that such cost is related to that specific financial year period which you are reporting in your tax return, and clear documentation can be provided based on the subsequent invoices issued or any payment made in the subsequent year against such accruals. So these are the general challenges we face with tax authorities. If your documentation is properly maintained and in line with the requirements of tax authorities, this cost will be allowed by tax authorities. Ispa, can you move to next slide, please? Thank you. We'll talk about ER 38, which talks about interest expenses and charges, which is claimed by taxpayers in their tax returns. So if you see that the first part is saying that interest on paid on loans by the local bank, it will be straight away allowed by tax authorities. But if it is paid outside, like any interest paid to your head office, which is allocated from head office or allocated from your third party, this will not be allowed as a chargeable expense, and in practice, tax authorities disallow this as a chargeable expense. If you are participating in any project and you have a counter guarantee charges which is paid outside Kuwait, that can be allowed by tax authorities, but they need certain documentation for that. First of all, there should be a attested certified translation of counter guarantees, and it should be relating with the bank guarantee submitted by your local bank. If all this documentation is provided, then this part of counter guarantee charges either charged by your head office bank or any other bank outside Kuwait can be claimed and can be allowed as a chargeable expense. Other than that, any expenses, any loan or interest paid outside Kuwait is challenged by tax authorities and it is not allowed as a chargeable expense in your Kuwait books. In addition to that, we have insurance cost, which is always challenged by tax authorities. So part of this executive rule is very clearly provided that any insurance cost which is paid outside Kuwait will not be allowed as chargeable expense. The tax authorities only give exception where you are paying this insurance for any import of material or equipment from outside Kuwait. That can be allowed as a chargeable expense. But if you paid for employees, medical allowance or anything, this kind of insurance is straight away rejected by tax authorities as a chargeable expense and will not be allowed uh, in your final tax assessment. On the practical challenges on interest, because now companies who are participating in BOT projects and sometime under the IFRS regulations, we can see that there is a little bit uh, difference is coming from the practices of tax authorities or tax regulations than the IFRS regulations or based on the BOT projects. Where Fahim, I don't know if you want to share your experience on BOT projects, where I believe that the tax authorities normally challenge the amortization as well. So maybe you can share your experience on that, Fahim?
Yeah, thanks, Hanan. I think on long-term projects where you've got financing for the initial sort of construction of plant, eh, there has been the discussions with the tax authority on how to claim finance costs. Currently, what the position of the tax authority is to claim finance costs over the life of the asset or the life of the duration of the whole contract, rather than looking at it from more aligned with IFRS position, which is to claim the interest in the year that it is incurred once the asset has come into use. So here, I think the executive rules are silent as to when you stop capitalizing interest. It just says that you capitalize interest for those loans related to asset construction, but it doesn't say when you stop. So based on that gap, the tax authority potentially have taken a position, but those are under discussions, and I think this hopefully will get clarified in the coming months. We also hope that tax authority, seeing that there is obviously a lot of projects coming up in Kuwait's Vision 2035, a lot of long-term high-value mega projects in the pipeline. So really, we have discussed with the tax authority to look at some of the executive rules to take into account the more longer-term projects that are potentially now being tendered on a BOT project, a BOT basis, or on a PPP basis. Yeah.
Yeah, I agree with you, Fahim. I think there is more clarification required, and we are expecting the tax authorities will be issuing more clarification on that. So, for the sake of time, I think we are ahead of time now. So, maybe we can go to next slide, and we covered all the topics today. So, maybe Fahim, you can.
Yeah, so thanks again. I think we do see a couple of questions which we can address separately and directly with those participants, because we are out of time. We have on the screen, you can still connect with us through the QR code, scanning the QR codes, and ask us a question through Microsoft Forms. So we've set that up for you. Also, you've got the QR codes and the link to our Doing Business in Kuwait guide, which we published earlier this year. And we're happy to have feedback on the event as well through the third QR code that's on the screen. So again, thank you, everybody. I think, Zubair, any last closing remarks?
No, again, thanks everyone, and hope to see you. I think our webinar, the series of webinars will continue. So we hope to see you register and e-meet you definitely in our next webinar. Thank you again for joining us, and thanks to all participants and from both KPMG as well as the client side. Thank you. Bye-bye.
Thank you, everyone.
Thank
Thank you,
you.
everybody. Thank you.
Thank you.